So, good evening, ladies and gentlemen. My name is Sergei. These are my colleagues Alexei, Vyacheslav, and Gleb. We're from Kyiv School of Economics, Ukraine. And for the first time, Ukrainian team had an opportunity to analyze a global company. We are very happy to present you our investment report on SES. SES is the world's second largest satellite fleet operator. With the largest fleet of 56 satellites, the company has 21% global market share, is traded on Luxembourg and Euronext Paris stock exchanges with capitalization of over 9 billion euros, and 58% of that constitutes free float. Key points that drive our investment recommendation for SES are unprecedented launch history for over 13 years already, growth opportunities in the emerging markets, and we believe that the company will generate even more cash in the future. We initiate coverage of SES with buy recommendation and see 15% upside to the current stock price, with two major reasons why it is currently undervalued. First of all, there is substantial but yet unrevealed value hidden in O3B project. And secondly, net income distortion was short-term accounting issue, not an indicator of performance decrease, which was misinterpreted by the market.
So let's take a closer look at the company. At first, we should explain you how a satellite industry works. The business process could be conventionally divided into 4 main stages. Firstly, the satellite operator should negotiate the right to occupy an orbital slot. This procedure could take up to 3 years. Further, construction is outsourced to the satellite manufacturer and costs 80 minutes on average. Following the manufacturer stage, satellites are transferred to the launch site. It costs around 40 million euros to put the satellite in the orbit. Finally, once the satellite reaches orbital position, the transmission capacity is leased to the customers. On average, each satellite generates 32 million euros per annum and operates for 15 years. Media, including BBC, Canal+, Discovery, Sky, is the largest SES customer, accounted for 70% of total revenues. It uses satellite services primarily for content delivery, directly to customers' homes or through terrestrial networks. Satellites also allows broadcasting from any hot point, such as Euromaidan, for example. The other 2 clientele groups are enterprises, including Boeing, AT&T, and government, where United States accounts for the largest part of revenues. Luxembourg State is the biggest SES shareholder. This permits SES to enjoy a more favorable tax regime comparing with other corporate sector. Also, SES holds almost 47% of O3B networks, which could be increased via the right of the first offer. O3B Networks is the next generation satellite services provider. It operates satellites on lower altitude, which allows much faster and cheaper information transmission. This technology provides high-quality internet connectivity and mobile communication for emerging markets. We believe that O3B networks could be the main growth driver for SES in the future.
So now let's explore the industry. The company is started to macroeconomic drawbacks. Backlog is 4 times year revenue and has been growing 7% annually. We expect high growth in international markets and slight increase in feeding ones as Europe and North America. Media, main customer, is anticipated to grow 5% annually next years. SES persistently outperforms comparing indexes, for example, entering long position 10 years ago, before crisis in 2007, and after crisis in 2010. SES holds strong position in Europe and North America and has expanding opportunities at international scale due to yet presence of large number of small, less competitive players there. We examine industry in 5 dimensions. Market is moderately concentrated with 4 major players. There are small but sufficient number of launchers and constructors. We see the threat of terrestrial networks in long-term horizon, but not a non-achievable situation as cruises, emergency, etc. Entrance pressure is unlikely due to satellite cost of 80 million and scarce number of orbital slots. Low collision power with high switching costs weaken our customers. To conclude, we can say that overall situation is beneficial for players' prosperity.
Let's consider financials. SES is anticipated to experience growth both in revenue and profit over the next 5 years. Revenue will be driven up by the performance in the international segment by around 6% each year. Profit will go up by around 9% per annum. Return on equity is anticipated to increase from 18 to up to 21% over the next 5 years. Currently, shareholder value is created through profit margin and financial leverage, yet we expect a shift in ROE drivers over the next 5 years. In the future, return on equity will be generated majorly through further increase in profit margin and growing asset turnover. Financial leverage will be employed more conservatively. We see positive trends in terms of SES debt position. Declining debt ratios mean higher solvency level. We also forecast a beneficial proportion between long-term and short-term debt. The company is forecasted to generate much more cash over the next 5 years due to reaching CapEx cycle bottom. This excessive cash generated may be used either for further increase in stake at O3B, other M&As, repaying debt, or distributing cash among shareholders.
So let's proceed to valuation. We did DCF and comparable analysis to come up with price. Adjusted beta and weighted market premiums result in equity cost of 9.2%. Yield on last bond issue gives a debt cost of 5%. Counting for forecasted capital structure, we get the VACC of 7.7. We build 3-stage model. Terminal value is estimated by Gordon growth and exit multiple methods. Management states dividend growth of 9%, which is sustainable according to our calculations. CapEx, forecasted based on management statement at midterm horizon, and based on previous cycle with slight increase in long-term horizon. DCF price is almost 26 euro per share.
Since we have a limited number of comparables for relative valuation, we decided to use an extended number of multipliers. As can be seen, SES multipliers do not differ much from peers' average. The price we get is 21.76 euro per share. Combining DCF and relative valuation approaches with 75 and 25 weights produces 24.91 euro per share. Since we believe that O3B networks could add a significant value to SES, we built a separate model to evaluate it. We use larger WACC comparing with SES, adding up startup premium. We expect utilization rate to converge to SES average. Also, we assume 2.5% of terminal growth rate. Based on our model, we estimate O3B premium as 1.23 euro per share. Finally, our SES valuation results in 26.14 euro per share.
The recommendation we give could be undermined by some risks. There are those specific to the company that are common to the industry. We shall discuss those that are most important. First of all, SES has excessive overcapacity, as the need to fill up transponders could put downside pressure on transponder lease prices, and that could hurt revenues. But that is going to be addressed by launching less than competitor satellites in the nearest future and designating this new capacity to the most growing regions, high-definition television in Europe and emerging markets, Africa and Asia. Although there have been defense spending cuts in the US and more are expected, so that also could potentially hurt revenues. But industry-wide, SES has a lower share attributable to government revenues, so if this were to happen, our company will be less affected. We also see a slight exposure to foreign exchange risk and a threat of terrestrial network spreading, because fixed broadband connectivity, which is now penetrating distant regions of Central Africa, provides a much cheaper solution than satellites. But what can be done about that is efficiently done by SES, going into emerging markets first and developing low-cost solutions, like O3B. Overall, important risks are very well addressed by company management, which supports our buy recommendation and a target price of 26.14 euro per share. With that said, we thank you for your attention, and now we will gladly take your questions.